$10 a day. That's it. That's the whole ask. Not $10 an hour. Not 10% of your paycheck. Just $10. About the price of a takeout lunch you'll forget by tomorrow, or a streaming subscription you don't actually watch, or the difference between the medium coffee and the large one you didn't need. You skip it. Not forever. Just today. And you put that $10 somewhere that grows. Most people hear a number that's small and dismiss it instantly. $10 can't possibly matter. It feels too tiny to be worth the effort of even opening an account. So the money gets spent on something forgettable, the habit never starts, and the same conversation happens again next year and the year after that. $10 a day, ignored for decades, quietly becomes the difference between retiring comfortably and working until you physically can't anymore. Let's actually do the math, because the math is the whole story here. $10 a day is roughly $300 a month, or $3,600 a year. Invest that every month for 40 years in a simple, low-cost index fund tracking the overall stock market, and history gives us a reasonable long-term average return of around 7% a year after inflation. That figure isn't a guess pulled from thin air. It's based on decades of S&P 500 performance data that firms like Vanguard and Fidelity publish and update constantly, smoothing out the wild swings of any single year into a long-run average. Run those numbers, and $300 a month for 40 years doesn't turn into the roughly $144,000 you actually put in. It turns into something closer to $700,000. Not because you got lucky. Not because you picked the right stock at the right time. Because time did almost all of the work quietly in the background while you were living your life. Before we go further, it's worth decoding a term that gets thrown around a lot in these conversations: dollar cost averaging. It sounds technical, but it just means putting in the same amount of money on a regular schedule, regardless of whether prices are up or down that week. Some months your $10 buys a little more of the fund, some months a little less, and over decades it evens out. You're not trying to guess the best day to invest. You're removing the guessing entirely. Here's the part that trips people up, and it's worth sitting with for a second. In the first year, that $10 a day feels completely pointless. You'll have put in around $3,600, and it'll have grown by maybe $250. You could have earned more than that at a single weekend of overtime. This is exactly the point where most people quit. They open the account, check it after 12 months, compare the tiny return to the effort of setting it up, and decide investing is a scam designed for people who already have more money than they know what to do with. But compound growth doesn't behave like a weekend job, and it doesn't behave like anything you've been trained by everyday life to expect. It behaves like a snowball rolling downhill. In year one, the snowball is tiny and it barely picks up any extra snow as it rolls. By year 20, that same snowball has grown so large that each single rotation adds more mass than the entire snowball weighed back in year one. This isn't a metaphor stretched to fit the point. It's literally the mechanism behind compound interest, a mathematical relationship formalized centuries ago and still cited by economists today. Albert Einstein is often, and somewhat loosely, credited with calling compound interest the most powerful force in the universe. Whether or not he said it exactly that way, modern financial researchers at firms like Morningstar have spent years tracking precisely how return sequencing plays out over multi-decade periods, and the pattern holds up. The growth in the back half of the timeline dwarfs everything that happens in the front half every single time. Let's also address the account itself, because where you put the $10 matters almost as much as the habit of saving it. In the United States, two of the most common vehicles for this kind of long-term investing are a 401k, which is a retirement account offered through an employer, and a Roth IRA, which is an individual retirement account you open yourself through a brokerage. Decoded simply, a 401k often comes with an employer match, meaning your company adds its own money on top of yours up to a certain limit, which is functionally a guaranteed, instant return before the market even does anything. A Roth IRA doesn't have a match, but it grows tax-free, meaning you never pay taxes on the growth as long as you follow the withdrawal rules in retirement. Neither of these accounts is complicated once you strip away the acronyms. They're simply containers that hold your $10 a day and let it grow with certain tax advantages attached. So let's reconstruct what those 40 years actually look like, because a chart on a screen doesn't feel real the way a life does. Picture yourself at 25. You open a simple retirement account, the kind that takes 15 minutes to set up online. You automate $10 a day into it, so you never have to think about it, never have to feel the small sting of manually moving money, never have to rely on motivation on a random Tuesday morning. For the first 5 years, nothing exciting happens. Your account grows to maybe $20,000. Friends around you are buying new cars, taking vacations funded by credit cards, upgrading apartments they can technically afford but not comfortably. Your investment account looks unimpressive by comparison, sitting quietly in the background of your life. This is the boring middle that almost nobody shows you on social media, because boring doesn't get views, and a flat, unremarkable line on a chart doesn't make anyone stop scrolling. By 30, the account sits somewhere in the mid-five figures. It's still not exciting. If you compared your progress to a friend who took on debt to fund a flashier lifestyle, you might even feel behind. This is normal, and it's temporary, though it never feels that way in the moment. By your late 30s, something starts to shift. The account has quietly crossed six figures, and now the growth itself, not just your contributions, is adding thousands of dollars in some years without you lifting a finger. You'll live through at least one real market downturn in this stretch, a period where the account value drops and the financial news gets loud and alarming. This is not a flaw in the plan. It's a scheduled part of it. Every multi-decade stretch of market history, including the dot-com crash in the early 2000s and the financial crisis of 2008, has eventually been followed by a recovery that pushed markets to new highs. The people who kept contributing through those downturns, buying in at lower prices without realizing it, ended up better off than the people who panicked and stopped. This is worth repeating because it's counterintuitive. A crash, while your $10 is still coming in automatically, means your same $10 buys more shares at a discount. The scary years are often quietly the best years to keep going, not the years to stop. By your late 40s, the account has usually grown enough that the annual gains in a strong year start to noticeably outpace your annual contributions. This is the stage where compounding stops feeling theoretical and starts feeling real, because the numbers on the screen begin moving in increments that used to take you months of saving to produce. By your 50s, the account is growing by more in a single strong year than you contributed across your entire 20s combined. And by the time you're in your mid-60s, that quiet, unglamorous $10 a day has become a 6- or 7-figure asset that can fund a real chunk of your retirement, all without you ever needing to pick a winning stock, time the market, or earn a dramatically higher income than you have right now. Now here's the counterintuitive twist, the part that upends how most people think about this entirely. The specific $10 almost doesn't matter. What matters is the decade you start in. A 25-year-old investing $10 a day will, under the same historical average returns, end up with dramatically more money than a 45-year-old investing $20 a day purely because of the extra 20 years of compounding time working in the background. This is backed by a widely cited comparison financial researchers use called the tale of two investors, where an early investor who contributes for only about a decade and then stops entirely still ends up ahead of a later investor who contributes diligently for the following 3 decades straight. Time, not amount, is the dominant variable in the equation. Waiting to invest until you have more money, until the job feels more stable, until the timing seems better is, mathematically, one of the most expensive decisions a person can make, even though in a moment it feels like the responsible, patient choice. It helps to see this side by side. Someone who starts at 25 and invests $10 a day will, by 65, have contributed roughly $146,000 of their own money. Someone who waits until 35 to start, investing that same $10 a day for 30 years instead of 40, will have contributed roughly $109,000, only slightly less. But because they lost an entire decade of compounding at the very beginning, when the snowball needed the most time to gather size, their final total ends up dramatically smaller, often by several $100,000, even though the difference in what they actually paid in out-of-pocket was relatively small. 10 years at the start of the timeline is worth far more than 10 years at the end of it. This reframes what "I don't have enough money to invest" actually means. It's rarely a math problem. It's usually a permission problem. People wait for a bigger paycheck, a clearer 5-year plan, a more confident feeling before they start. And every single month of waiting is a month of compounding that can never be recovered later, no matter how much extra money gets thrown at the problem afterward. The $10 was never really the constraint. The delay was. There's also a psychological reframe worth sitting with here, because it explains why this specific number works better than the alternatives people usually try first. $10 a day is small enough that it barely registers as a sacrifice, and that's precisely why it survives contact with real life. Big, dramatic financial resolutions, like slashing your entire budget overnight or investing every spare dollar the moment you get paid, tend to collapse within a few months because they demand constant willpower, constant tracking, constant self-denial. Willpower is a finite resource, and it runs out the same way a diet built on total deprivation usually collapses faster than one built on one small sustainable change. A habit that costs you almost nothing to maintain, that happens automatically before you even see the money, is a habit you'll actually still be doing in year 30. The unglamorous size of the number is the feature here, not the flaw. Think about what this does to how you experience a single day, too. A missed $10 today doesn't feel like anything at all, which is exactly why it's so easy to let it slide once, then twice, then indefinitely, until the habit quietly disappears. But a kept $10 today, repeated automatically without ever requiring your motivation on any given morning, is what actually produces the $700,000 outcome decades later. The daily decision is small, almost invisible. The compounded result of thousands of those small, invisible decisions is not. It's also worth mentioning what happens if you let that money simply sit in cash instead of investing it. Inflation, which is the gradual rise in prices over time, quietly erodes what your money can actually buy if it isn't growing at least as fast as prices are rising. $10 saved in a drawer or a low-interest checking account for 40 years will still say $10 on the bill, but it will buy noticeably less than it does today. Investing isn't just about growth for its own sake. It's about making sure your money keeps pace with, and ideally outruns, the rising cost of everything around you. So here's the mirror back onto your life right now, today. You almost certainly spend $10 somewhere this week without noticing it happen. A coffee you didn't strictly need. A subscription you forgot you were even paying for. A convenience fee attached to an order you placed on autopilot. None of those individual choices are moral failures. They're just invisible, because $10 feels too small to consciously track in a busy week. That invisibility cuts both ways. It's exactly why the money leaks out unnoticed in the first place. And it's exactly why redirecting even a fraction of it can go just as unnoticed in your favor this time. You don't need a financial windfall to start this. You don't need to understand every acronym in the investing world before you begin, and you don't need to correctly predict what the market will do next month or next year. You need one small, boring, automatic decision, repeated for far longer than feels reasonable or exciting, inside a market that has, over every meaningful multi-decade period in recorded history, trended upward despite wars, recessions, and crashes happening along the way. $10 a day. That's it. That's the whole ask. Not because $10 is magic, and not because this is some secret nobody has ever told you before. It's because time turns small, boring, repeated decisions into outcomes that look, decades later, like they must have required a fortune and a genius plan to begin. They didn't. They just required today, and then tomorrow, and then not stopping.